Assalammualaikum warahmatullahi wabarakatuh and hi. Welcome to our presentation. So today we are going to present our final year project, that is modeling and forecasting the volatility and price of gold price. We would like to introduce our team members. So I am Izzah Nazihah binti Ejap. The second member is Hamizah binti Muhammad Ariff, and the last member is Huda Athirah binti Abdullah. And our supervisor is Dr. Nisa binti Khairul Azmi. So we start with the introduction. So basically, forecasting uses a historical data in predicting the direction of future trends, which is for an upcoming period, for example, assigning budget or planning. So what is stock market? So stock market is prone to ups and downs in share prices, while volatility defined as a sign of a stock market with a lot of liquidity. In this study, gold future market data were used to model volatility. So the assumption that gold can be treated as a store of value has attracted a lot of attention. As the risk in the stock and bond market increased, investors were interested in raising the position in gold. So we used generalized autoregressive conditional heteroscedasticity, which is gauge models, to capture the patterns of gold volatility.
Next, I am going to explain about problem statement in the study. Basically, gold had becoming precious assets which managed to attract many investors, and the demand has increases over time. Consequently, as the rise of demand of gold around the world, it is significant to develop a model that could reflect the pattern of gold market and forecast movement of gold price. So, by looking at historical gold prices may potentially provide information that may assist in buying or selling decisions. Besides, the asymmetry effect is considered in this study, in the sense that partial some positive and negative changes in uncertainty measures might have differing effects on gold prices. Additionally, there are limited studies have been conducted on forecasting gold prices using gauge, E-gauge and T-gauge models. Hence, it become the main purposes for this study. Here are the objectives of this study. These objectives help in constructing proper guidelines for method of analysis. So the first one is to model the volatility and the return of gold price. The second one is to assess the performance of the models, and lastly to forecast the gold price and risk and the future for 30 days.
Next, I will explain about the scope and limitation of the study. This study is focused on comparing model and focused by using the generalized autoregressive conditional heteroscedasticity, or also known as the gauge family models. The period of the study will be between January 2016 until October 2021 and will be collected in daily forms by using the secondary data taken from the Yahoo Finance website. For this slide, I will explain about the significance of the study. The significance of predicting the gold price is to maintain the remaining assets of a company, as gold is the best investment, even though the price is only increases from 3 to 4% per year, but it can protect its value from the inflation.
As for the source of data, we use the secondary data that was gathered from the Yahoo Finance, and the period of data that will be used in this study is from January 2016 until October 2021, which is in daily form, and the analysis will be conducted by using the R software. So this is the overall procedure of gauge models. So the first step is to double check the stationary by using the augmented folder, which is ADF test, and then the second step is to estimate the parameter by using the maximum likelihood estimator. So the third step is to perform the dynasty checking using the Langbox and Lagrange multiplier, which is LM test. And then each model's performance will be assessed by using the AIC, BIC and HQIC. And finally, the model with the lowest AIC, BIC and HQIC value indicates the best models and will be chosen for forecast the future gold price. Checking for stationary. So what is stationary? Stationary refers to a situation where the time series data fluctuate around the constant value, and also the variance remain constant throughout time. As mentioned before, the ADF test is one of the tests for evaluating the current data. So this is the null and alternative hypothesis for ADF test. So we move to the first model, which is gauge model. So gauge model is an expansion of ARCH models of Eagle 1982 and is a methodology for explaining future deviations that consider prior variations. So here we use the gauge 1-1 model, and the formula is given as follows. So based on the formula, the mean value is expected to be small and positive. The conditional variance equation is given as follows.
Next, I am going to explain about E-gauge model. The E-Gauge model is adequate for systematically explaining the leverage effects that are commonly observed in financial time series. This model also incorporates the asymmetric influence of positive and negative shocks on volatility, with the latter producing higher levels of volatility although having the same magnitude. The last model that is going to be used in this study is T-Gauge model. Threshold gauge model were another model developed by Zakoyan 1994 that employed in this research, as this model was well suited to capture an asymmetry effect. The T-Gauge model specification assumes that unexpected changes in the market returns or they will have different effect on the volatility of stock return. Basically, a T-Gauge 1-1 model assumes the form as above. Now I'm going to explain about parameter estimation. Basically, the maximum likelihood MLE method is used in this study to estimate the parameters of the model because it is generally consistent and efficient, and it offers asymptotic standard errors that are valid under non-normality. Next is the diagnostic checking using the lung box test. The lung box test, also known as the modified box Pierce test, is used to test for autocorrelation in the gauge model's standardized residuals. The test examines if the errors are independent and identically distributed, or whether the residual autocorrelation is non-zero.
The other methods to do the diagnostic checking is by using the adjusted PSI goodness of fit. The goodness of fit is a statistical hypothesis test that determines how well sample data fits a normal distribution from a population. It determines whether the data is representative of the data that would be found in the actual population or it is biased in any way. The formula is as above. After doing the diagnostic checking, we need to measure the performance of each model by using three types of method. The first method is a current information criterion. The formula is as above, where L is the maximized value of the likelihood function for the estimated model and K is the number of the parameters in the model. The model with the lowest value of AIC is the best fit model. Next is the Bayesian information criterion. It is similar to the AIC, which is the formula is as above, where L is the maximized value of the likelihood function and K is the number of parameters in the model. It is possible to increase the chances of fitting a model by adding parameters. However, this may result in overfitting. The last method to measure the performance is the Hannan-Klein information criterion, or also known as the HQIC. It can be used to compare estimated models only when the numerical values of the dependent variable are identical for all the estimates being compared. The aim is to find the model with the lowest value of the selected information criterion. For the first result and discussion is about the description of return gold price. The graph above shows the gold price from 1st January 2016 until 31st October of 2021. The data used in this research is the gold price and converted into percentage of return. As we can see from the graph, the price was moving up and down steadily until 2018. At the beginning of 2019, the price started to hike significantly and peak exceeded $2,000 by the mid of 2020. Next is to check for the stationary. As we can see, for the gold price, P value is 0.6491, which is exceed 0.05. It concluded that the gold price is not a stationary data. Since the gold price is not stationary, the first order of differencing was performed. In investment, data of first order of differencing is called as return, and we can see from the result of the return, the P value is 0.01, which is less than 0.05, and it concludes that the data return is stationary. Next, the figure above shows the chart series of the return of gold price from the year of 2016 to 2021. The chart reveals that the return of data after logarithm transformation is weakly stationary with the values volatile around zero. This is the description of gold price return. As you can see, the number of observation is 1464, the mean, median and standard error is 0, while the skewness is negative 0.01, which is closer to 0, and the kurtosis is 5.72. The distribution is approximately symmetric since the skewness is negative 0.01 and the kurtosis is 5.72, indicating that the tails are longer and fatter and the central peak is high and sharp. This graph above is the distribution of gold price return. The distribution of gold price return from January 2016 until October 2021. The return for the gold price is peaked at 0.00, which means that there are many days investors not getting any profit or loss in the stock market. Next, I will explain about the return of gold price running performance annual volatility, and the graph is shown as above. From the year of 2017 to 2018, the volatility decreased and the risk to invest in the gold stock market in the year of 2017 was also descended, and the stock market was stable until the mid of 2019. There was a steady increment to the volatility from the year of 2019 until the early of 2020. When the pandemic started hits the world in the beginning of 2020, the volatility was increased tremendously and the risk of invest on gold is higher. The table above shows the result that we get for GACH11 model by using the R programming language. As we can see that there are 4 parameters, which is mu, omega, alpha and beta. The p-value for mu is 0.27453, omega is 0.30045, while alpha and beta is 0.000. Alpha and beta is statistically significant because they are less than 0.05. The table above shows the result for Lombard test for standardized squared residuals. The Lombard test on standardized squared residuals results states that the null hypothesis has no serial correlation. Since the p-value is greater than 0.05, we failed to reject #null. Therefore, it is indicated that there is no evidence of serial correlation of standardized squared residuals. Hence, the residuals is behave like white noise process, which means that the GACH11 model is valid for modeling gold price return. The other methods of doing the diagnostic checking is adjusted Pearson goodness of fit. As we can see from the table above, the p-value is less than 0.05, indicates that the model is a good fit model. Next is the quantum plot, or also known as the QQ plot. Figure above shows that the QQ plot for GACH11 model. It appears that the QQ plot is a fade tails since it is away from the straight line in the beginning and the end of it. While its center follows the straight line, this indicates that it does not fit for the normal distribution and having a small numbers of outliers. For checking the autocorrelation error, we use the autocorrelation function, or also known as ACF graph. Figure above shows the ACF of square standardized residuals of GACH11 model. The result shows that there is no significant lag at the level of 0.05. It is also determined that there is no autocorrelation problem for GACH11 model. Next is the news impact curve. As we can see from the graph, the news impact curve is symmetric to each other because the GACH11 model does not take into consideration of the bad and good news to the data series.
So this is the result for parameter estimation of eGACH11 model. As we can see, the coefficient of alpha parameter were positive and significant, which reflects the shock effects. Then, the coefficient of beta parameter indicate the volatility persistent was also positive. From the table also, the gamma parameter indicates that the shocks have an asymmetry effect on the gold return volatility. Next, the diagnostic checking of eGACH11 model using the weighted Lombard test on standardized square residual. So based on the result, the p-value was higher than 0.05. Thus, failed to reject the null hypothesis and conclude that there is no autocorrelation problem on standardized square residual. We move to the adjusted Pearson goodness of fit test. From the table, all the p-values were smaller than the significant level, which is 0.05. So the null hypothesis should be rejected. So it indicates that the observed data was different from the expected distribution. QQ plot of standardized residuals of eGACH11 model. So based on the QQ plot, we can see that the line is nearly a straight line, except for some outliers in the left and right tail. So this is called a distribution with a fat tail. Why? Because both the end of the plot deviate from the straight line, thus making it the perfect fit for normal distribution. Next, the autocorrelation function of square standardized residuals of Izzah model. So based on the correlogram, we can see that all the legs have low spikes and located within the confidence limit. It means that it was stationary and well fitted for the data series. So the last part of the Izzah model is news impact curve. So we can see from the graph, it shows that the V-shaped curve, which implies that the past positive and negative shocks of the same magnitude have the same effect on the conditional volatility.
The table shows 5 parameters which are mu, omega, alpha, beta and gamma for Izzah model. Based on the result, alpha and beta terms are all significant. The gamma term is negative for Izzah, implying that past returns have negative impact. This also indicates that gamma term should be dropped from the model. Next, we're going to take a look to diagnostic checking of Izzah using the lung box test. So based on the result that shows lung box test for Izzah, since the p-value is greater than 0.05, the residuals of Izzah model is independent and identically distributed. Thus, fail to reject null hypothesis and indicates that there is no autocorrelation on residuals. This result is adjusted Pearson goodness of fit test. So based on the result, since all the p-values are smaller than significance level, which equal to 0.05, so we reject null hypothesis. This also indicates that the observed data are statistically different from the expected values and the data does not follow a distribution with a certain proportion. The normality assumption pertaining standardized residual can be visualized using QQ plot. The distribution likewise has a fat tail with both extremities of the QQ plot dividing from the straight line, but the middle of the plot remains straight, thus making it a perfect fit for the normal distribution. Next, we are going to take a look to the SEF of squared standardized residuals. So based on the SEF of the standardized residuals of Izzah model are lies within the confidence interval. This likely indicates that there is no serial correlation problem in the residual of Izzah model. The news impact curve established a non-linear relationship between previous returns and current volatility. So based on the result, the graph shows the asymmetric impact of negative news on volatility. The model is symmetric and U-shaped curve, implying that the past positive and negative shocks of the same magnitude have the same effect on the conditional volatility.
This is the overall result for model comparison between Izzah and Izzah model. Based on the result obtained, the Izzah model has the lowest value of AIC and HQIC. So it indicates that the Izzah model is the most outperformed model compared to the other model. So overall, the Izzah model is the most appropriate model for forecasting the future gold price.
Now we are going to forecasting using the best model. The prediction was executed by using the Izzah model since it is the best model among the 3 models. Based on the result that we get, this indicates that the return of gold price 5 days ahead is more than 0. It means that there is a low positive return for the gold price based on the predicted values by using Izzah model. So as you can see here, this is the daily return of gold price forecast for 30 days ahead from the data origin. The red line shows the forecast values and exhibit constant values for the next 30 days period of forecast. It shows that the gold price not giving much profit or loss in the future. The next one is the result of value forecast volatility in 5 days. As you can see here, it is increasing, indicates that it can potentially be spread out over a greater range of values if its volatility getting higher over the time. This also means that the return of gold price can swing drastically in either way in a short period of time. Based on the result, the blue line indicates the actual volatility and the red line indicates the forecast volatility. The forecast volatility has increased slowly over the time.
According to the result obtained in this study, we would like to conclude that the Izzah model fits the series well and outperforms the other models. So the superiority of the Izzah model for modeling the series is highlighted by the lowest AIC and HQIC values compared to the Izzah and Izzah model. So therefore, the TH11 model is the most potential approach in modeling and forecasting future gold prices.